welcome to the deep dive. This week, honestly, the market spun a fascinating tale. Almost felt like a contradiction, didn't it?
It really did.
I mean, you've got the S&P 500, right? Key indicator, climbs above 6,500.
Yep.
First time ever.
A historic high, yeah.
Exactly, truly historic. But here's the kicker, the really interesting part.
Yeah.
It did this while headlines were swirling about Fed independence being questioned.
Being questions there.
Rising yields in the bond market, major moves there, and these looming tariff threats. Multiple fronts.
Mm-hmm.
It really felt like the market was just, shrugging off huge concerns with one hand
Yeah.
while reaching for new records with the other. Just bizarre.
Well, what's truly fascinating, as you say, is precisely that juxtaposition, that apparent contradiction in the signals. You have these clear pressures building up, bond market skepticism, trade policy getting tougher. Yet equities just kept marching upwards. So our mission today for you listening is to unpack these complex kind of opposing forces.
Yeah.
We want to help you understand what was really happening beneath those headlines and crucially what it might mean, for the financial landscape ahead.
Got it.
We're going to navigate these tricky waters and pull out the key insights from the week's market story.
Okay, let's dive in then. Let's start with what really dominated the headlines and, frankly, caused quite a stir, the central bank drama.
Ah, yes. The Fed. Again.
Right. Our sources point to the Fed again. But this time, it felt, personal. It touched the very foundation of central bank autonomy.
It really did.
So what exactly went down with President Trump and Fed Governor Cook? Why did that stir things up so much? And importantly, why should we care?
Okay, so President Trump openly tried to remove Fed Governor Cook via tweet.
A tweet. Wow.
Yeah. And that immediately sparked fresh questions about, that vital concept, central bank independence.
Which is critical.
Absolutely critical. And look, this isn't just like political noise. It has very real, tangible financial implications. Well, when the perceived independence of a central bank gets challenged like that, it can really erode investor confidence. Confidence in future policy decisions.
Okay.
And the bond market especially reacted with very clear skepticism about the Fed's policy independence going forward. It signals kind of deeper distrust, maybe, in its ability to act just based on the economic data.
So the bond market showed skepticism. What did that actually look like, on the ground? What were the concrete signs of that pressure?
We saw long-end treasuries push higher.
Okay, yields up.
Yields up, meaning investors were demanding more compensation, more yield for holding longer-term bonds, basically pricing in more risk or uncertainty.
Makes sense.
And crucially, the 2/30s yield spread. That's the difference between the 2-year and 30-year Treasury yields.
Yeah, the curve.
Right. Often seen as a bellwether for long-term economic expectations, maybe a recession risk. It hit its widest point in over 3 years.
Wow, 3 years. So that's significant.
It's a very significant signal, yeah. Reflects increased investor caution, concerns about, future growth or maybe inflation.
Okay. Any other signs?
Yeah. Adding to that, we also saw pretty lukewarm demand at the Treasury auctions this week. Another tangible sign of investor apprehension. But, and this is the big but.
The disconnect.
Exactly. Despite these clear, measurable signs of pressure in bonds, the concerns about Fed independence, equities, like you said, just largely brushed it off.
Incredible.
Major indices set new highs. Strong week for cyclicals, the Dow led. So it really raises that important question for all of us. Why? Why this disconnect?
So what's the theory?
Well, the sources suggest it highlights, and I quote, investor faith in Fed cuts later this year.
Ah, the hope for cuts.
The hope for cuts. But I think it's maybe more than just belief. It's also about where capital is flowing, right? Concentrating in sectors seen as resilient or maybe poised for a rebound after cuts.
Okay.
And that could be masking some underlying fragility elsewhere in the economy. It's sort of a selective optimism thing.
Selective optimism. I like that. So, okay, equities are kind of ignoring the political noise around the Fed, banking on future cuts. But while that's happening domestically, we also had big moves on the global trade front this week. Another layer of complexity.
Absolutely. Always something with trade, isn't there?
Seems like it. So what were the specific new concerns this week? What's adding to that picture?
Well, we saw a new investigation launched into furniture imports.
Furniture, okay.
Yeah, and it could potentially lead to tariffs as high as 50%. 50.
Whoa.
And furthermore, there were explicit teases, let's call them, that pharma and chip tariffs could be next in line.
Okay, so broadening out.
Definitely broadening. And then a key thing, often overlooked, the de minimis exemption, the one that lets low-value imports come in duty-free.
Yeah, for online shopping and stuff.
Exactly. That expired. And that's significant because it adds a whole new layer of duties, customs hassle, to a huge volume of e-commerce goods.
So it hits consumers more directly.
Potentially, yeah. It expands the tariff impact beyond just big manufacturers. It could hit every online shopper, small businesses. Connect that to the bigger picture, and it really suggests an escalating, widening tariff watch, much broader than before.
And it wasn't just traditional tariffs, right? The CHIPS Act came up again. Commerce Secretary Ludnick defending the government, taking a 10% equity stake in Intel.
Right.
What's the significance there? Especially with hints that maybe similar actions could happen in, say, the defense sector. That feels different, like a new kind of industrial strategy.
It absolutely is a different approach, yeah. It suggests a much more active government role.
More than just regulating.
Right, like directly investing in influencing these strategic industries. It's definitely a trend to watch. Could fundamentally reshape how companies operate in sectors deemed, critical to national interest.
Moving beyond simple tariffs.
To a deeper entanglement, yeah. And then you add the geopolitical backdrop. Peace prospects between Ukraine and Russia dimmed further. Talk of secondary sanctions potentially next.
All right.
So all these factors, expanding tariffs, government getting directly involved in industry, ongoing geopolitical tension, they create this complex, kind of unstable global environment. It inevitably influences market stability, corporate planning.
So for you listening, the big question, and the sources hit on this too, when these tariffs, these new policies kick in, who ultimately pays? Do they squeeze corporate margins for profits, or do they get passed on to consumers, to us, through higher prices?
That's the multi-trillion-dollar question, really.
Yeah, which brings us right down to the corporate level, where these macro trends really hit home. AI obviously still dominates headlines, investment talk.
Can't escape it.
But it seems like this week showed a really mixed picture for companies trying to actually use AI, right? Who were the clear stars and who kind of stumbled? Maybe showing the boom isn't, lifting all boats.
Definitely a mixed bag. In tech, Snowflake, that's SNOW, and MongoDB, MDB, were clear winners.
Okay.
Both, quoting here, blew out earnings and hiked guidance. Strong AI demand really helping their bottom line. Undeniable boost.
Nice.
NVIDIA also had a beat and raise Q2. Impressive, obviously, but its performance was a bit shattered by China sales uncertainty and just questions about how sustainable that crazy growth is.
Right. Can they keep it up?
Exactly. And then on the other side, you had Dell, DEL, and Marvell, MRVL. Their results kind of fell flat. The reports explicitly highlighted execution challenges and actually making that AI transition work for them.
Interesting.
So yeah, it's clear the AI boom, powerful as it is an automatic success. Depends on execution, navigating headwinds, maybe being in just the right niche.
Okay, so AI isn't a magic wand for everyone. But it wasn't just tech showing mixed signals.
Yep.
We saw some pretty serious warnings coming out of, industrial and food sectors, a very different economic picture.
Yeah, that was striking.
Our sources specifically mentioned growing stagflation fears.
Yeah.
Can you unpack that for us? What's driving those worries and why now?
Absolutely. So Caterpillar, CAT, big industrial name, they specifically warned that tariffs would, quote, weigh more heavily on FY profitability, a direct hit to their outlook.
Okay, tariffs biting.
Biting hard. And this wasn't just CAT. The editor's notes we looked at said this pretty much applied to the whole industrial sector and the food sector.
The whole sector, wow.
Yeah, we saw Hormel, HRL, JM Smucker, SJM. They both missed earnings because of surging commodity costs.
Input costs rising.
Exactly. So you put those two things together. Rising costs, that's the inflationary pressure.
Right.
Combined with potential slowing growth or lower profits because tariffs are hitting margins, that combination is precisely what fuels those stagflation fears.
Inflation plus stagnation.
That's the worry. A really challenging environment. Companies getting squeezed from both sides. Higher costs coming in, maybe lower demand or less ability to pass those costs on going out. Suggests, inflation without strong growth.
Yet. Here's another contrast.
Yeah.
Discount retailers apparently outperform peers with less year-over-year margin erosion.
Right.
Feels like another disconnect, doesn't it?
Yeah.
But maybe it's just, in tough times, people look for value, right? Is it just a predictable shift? Or something else?
Yeah, it does feel like another disconnect, yeah. But your point about consumer behavior is definitely key here.
Oh.
It suggests some companies, especially the discounters, are finding ways to navigate. Smart strategies, Cost cutting, supply chain shifts, price hikes.
Being agile.
Being agile, exactly. Yeah. Appealing to consumers who are getting more price sensitive. But it still leaves us with that critical question we raised earlier, which feels even more pressing now.
Right. Who pays?
Will tariffs ultimately hammer corporate margins across the board, forcing companies to eat the costs? Or will they trickle down to consumers as higher prices, fueling inflation even if growth slows?
And the different results this week just highlight that uncertainty.
Exactly. It shows the impact just isn't uniform at all.
Okay, so a lot going on this week. A real mix of signals to process.
Yeah.
As we look ahead, what should we, the listeners, be absolutely focused on? I'm guessing a packed economic calendar.
You are guessing correctly. Next week is absolutely packed with crucial economic events, stuff that will definitely influence market expectations, particularly around the Fed's next move.
Okay, break it down for us.
Right. Tuesday, S&P Global and ISM manufacturing PMIs. Key thing there is the prices and employment components.
To see if that industrial slowdown is spreading.
Yeah.
And how inflation's looking in manufacturing.
Precisely. Then Wednesday, Joel sees job openings for July, critical look at labor market health, demand for workers. Fed watches this closely.
Got it.
Thursday, we get the ADP non-farm employment report, also the ISM services PMI that covers the bigger part of the economy, another look at service sector inflation, plus the usual jobless claims.
Okay.
And then Friday, the big one, the official payrolls report, unemployment rate, average hourly earnings, the U6 rate.
The whole jobs picture.
The whole picture. This will heavily, heavily influence what people expect for the Fed's September 17th meeting.
And any Fed speakers.
Oh, yes. We've got Kashkari on Wednesday, then Williams and Goolsbee both on Thursday. Their comments, alongside that data, absolutely key.
Okay. Busy week for data watchers. Beyond the calendar, what are the market's internal signals telling us right now? Sentiment, indices. Especially with these conflicting stories we've discussed.
Well, the weekly sentiment for the S&P 500 is currently flagged as overbought.
Meaning maybe due for a pullback.
Potentially, yeah. Suggests it might be due for a correction, especially when you layer in those stagflation warnings from earnings. It's a sign the rally might be getting a little ahead of itself, maybe too exuberant given the underlying currents.
Okay, what else?
Conversely, the dollar index, the DXY, is marked oversold. And it continues to show weakness. That's a significant trend to watch. A weaker dollar impacts trade, commodities, lots of things.
Right.
And the fear and greed index, remember it hit extreme greed earlier in the week?
Yeah.
It cooled off a bit, back to just greed at 64 by the end of the week. So a slight tempering of that investor exuberance, maybe, but still, a long way from actual fear.
Still leaning greedy. Okay, and for listeners interested in digital assets, Bitcoin, what's the outlook there, given everything else?
Right. So with those anticipated rate cuts becoming more confirmed, the expectation is the dollar will continue its decline.
Okay.
And historically, that tends to benefit digital gold. Bitcoin is often seen as that alternative store of value when the dollar weakens.
So good for Bitcoin.
The forecast is for it to increase in value. Yeah. The specific next major resistance level mentioned was 125K.
Wow, okay.
So it's another area where the expectation of future Fed policy is directly driving market moves, a different narrative than traditional stocks or bonds.
Okay. So let's wrap this deep dive up. We've looked at a truly complex week. Market hits new highs.
Record highs.
While seemingly ignoring these really big questions. Fed independence, intensifying trade tensions everywhere, this growing specter of stagflation in key sectors.
It really does underscore the deep complexities right now.
Yeah.
You see this strong faith, maybe hope, in future Fed cuts pushing stocks up. Record levels. Even while the fundamentals, the corporate warnings from the ground, are suggesting caution.
It's a balancing act.
A fascinating, and you could argue, potentially precarious balance that investors are trying to navigate. Weighing that optimistic future policy against these immediate economic headwinds.
It really brings us back to that core question our sources posed for the week, and it's the one we want to leave you, our listener, with to think about. Will the market just keep ignoring these big Fed independence concerns as long as stocks keep going up? Is it just price solves everything? Or is there a point where these deeper structural issues, that the Fed's autonomy, the trade wars, stagflation, where they will demand attention, maybe even before the next rate cut actually happens? What stands out to you as the most important takeaway from this deep dive into the week's market story?